Okay, Plan B. All right, Plan B. Hill Company would open 3 larger shops at a cost of $8,340,000. This plan is expected to generate net cash inflows of $990,000 per year for 10 years. Which is the estimated useful life of the properties. Estimated residual value for Plan B is $1.2 million. All right, so payback we can calculate the same way. The cost of $8,340,000 divided by the annual cash flows of $990,000. So this one has a payback of 8.4 years. Not as good as the first one, but it's still less than the 10-year life. All right, then the accounting rate of return. Remember, we need the annual operating income. It's average annual operating income divided by the average investment. All right, so we have to figure the numerator out. All right, so we have total cash flow over the life is the $990,000 times 10 years, so $9,900,000. All right, minus depreciation over the life. Well, the depreciation is going to be that cost of $8,340,000 minus the salvage value of $1.2 million. All right, so my total operating income is going to be $2,760,000 divided by 10 years. So this is my average annual operating income. All right, so you come back up here and you put the numbers in. So 276, and then my average investment, remember, is your cost. So 8,340,000 plus your salvage or residual divided by 2. So when you work all that out, you get 5.8%. All right, and that number is not looking so good because they want 10%, and this one's only giving them 5.8. So it's not going to meet their minimum requirements. All right, net present value. All right, this is the present value of the annual payments or annual cash flow plus the present value of the residual or salvage, which this one has. All right, so it's still 10 years at 10%. So the first one's gonna be the same factor. So $990,000 is their annual cash flow times 6.145. All right, residual is $1.2 million. All right, the residual you're gonna only get one time at the end of 10 years. So this one, you use the present value of a dollar table, which I call a lump sum because you're only getting it one time. So 10% for 10 years is 0.386. So you're gonna use this number right here. All right, you add those two together. That's your total present value minus the initial cost, which was $8,340,000. So you get a negative $1,793,000. Oh, sorry, $250,000, which is not good. You don't want to invest in something that has a negative net present value. And then the profitability index would be your total present value divided by your cost In this case, it's going to be less than 1 because it has a net present value. So not a good investment.